Hi, this is Brad Stevens with BAS Financial, and today I want to talk about a subject that's really not unusual at all, and that is old 401ks and self-managed IRAs. And I deal with this with clients all the time when they come to me, and so I wanted to kind of answer a few questions about it and talk just a little bit about the subject. So, how does this happen? Well, we all have probably worked for a company, had a retirement plan, and left that company. We got a better job offer, we relocated, whatever it may be. And so we leave the old company, go to a new company, start contributing to that retirement plan. But most of us, or many of us, what we didn't do was take that old 401k, that old retirement account, and bring it over to the new employer. Pretty common. Or maybe you did realize that you had left your old retirement plan there and you decided rather than move it into your new plan, or you couldn't move it into your new plan, you opened up an IRA and you rolled it into that IRA and you chose some investments and you decided you were going to manage it yourself. This is a really common, not unusual thing to happen to have old retirement accounts at old employers or to have IRAs that you're managing yourself. It's pretty normal in the world, and I see this all the time with clients that I start to meet with and discuss. What surprises me though is not that this happens, but that how few people I talk to actually understand what they're paying for these retirement accounts and what they're getting for that. There's been a stat that I've quoted a few times online, and it's from a GAO study, I think in 2021, that says about 41% of people don't realize they pay any fees at all in a 401k. And that's current 401ks as well as former employer 401ks. So that's really the question I want to talk about today is what are these old 401ks and these IRAs costing you? Every retirement account has a cost. These fees are not really front and center. You may not realize they're there. You probably don't know what they are. Maybe you don't know what they are. But every retirement account has a cost, whether it's a 401k, an old 401k, an IRA you're managing, or an IRA someone is managing for you. All of them have fees. And maybe that's somewhat obvious. Some of those fees are obvious. So things like on your statement, you'll see a management fee or an administrative fee or an account annual fee, something along those lines. But a lot of the fees are really not that obvious, or some of the fees are not that obvious. And those are things like the expense ratios within your investments. So mutual funds all have an expense ratio. It's a cost of running that mutual fund. It's a cost of doing business for these investment companies. And a lot of times, those expenses, most of the time, those expenses are not a line item on your statement. It's not something that you're going to see sticking out front and center when you look at your statement or when you look at your account. They're buried, or I hate to use the term hidden, but they're kind of hidden within your account, and you may not even realize you're paying those fees. A lot of people don't realize they're paying those fees. Those fees are buried in those mutual funds and in those investment options. So the issue isn't whether fees exist. The question is, what are you getting for those fees that you're paying? The ones you realize you're paying and the ones you're not. Because again, all retirement accounts have fees. You can't get away from that. It's just a matter of, do you know what those fees are and what you're actually getting for those fees? So when it comes to old 401ks, another thing to consider is not just those fees, but when you're paying those fees, you got to think about do the limited investment options in those old 401ks and the fees that you're paying for those limited investment options make sense. When it comes to 401ks, whether it's a current employer or an old employer, um, you have a limited menu of options to choose from in how you invest that account. I equate that to go to Chipotle, they have a menu of food that you can order. You can't go to Chipotle and order a Big Mac from McDonald's or a In-N-Out cheeseburger. And so it's the same thing in 401k. You usually have somewhere between 15 and 30 investment options, and that is your menu of choices to choose from. Nothing wrong with that. That's standard across the industry when it comes to retirement plans. But also, because these old 401ks are with former employees, you probably aren't getting the same educational material. You're probably not looking at them on a regular basis. You're probably not in contact. If there is an advisor on the plan, you're probably not in contact with that advisor. And so you may be missing out on certain things by having that account at an old employer where you don't have the same visibility. And if there is an advisor, they're probably not reaching out to you because you're a former employee, and so you just don't have contact with that person. It's really easy to forget about these old retirement plans because they're not front and center. A lot of the statements now are electronic statements, so you may not even be seeing those in your email, or maybe you never updated the email in your account, and so it's going to your old work email and not your personal email. So a lot of things can make it easy for these old retirement plans to kind of just disappear, and you forget all about them. And when it comes to self-managed IRAs, again, you're paying fees on those as well. Um, the nice thing about those is you've got a lot of flexibility. There is a huge number of investment choices that you can have within a self-managed IRA that you get to choose from. More flexibility means more options, but also what comes with that is more responsibility. So, what's the old adage from Spider-Man? With great power comes great responsibility, or something along those lines. It's kind of like that with self-managed IRAs. You have a lot of choices, but that responsibility on choosing the right choices for you, that falls on your shoulders. There's no one to lean on in a self-managed IRA on how to make those investment choices. And maybe you're comfortable with that responsibility. Many people are, but maybe you're not. It just depends on your individual situation. But even after you've chosen those initial investments in that self-managed IRA, there's things like rebalancing you're responsible for. You have to reassess your risk level on a regular basis to make sure that those investment choices still match up with that risk level. Are the investments you chose 10 years ago still prudent, still suitable for where you are today in life? Because as we all know, life changes, and where you were 10 years ago is not where you are today, and it's now 10 years closer to retirement. And so you're responsible for analyzing, do these investments still match up with my current financial goals, not the goals when I originally set up the account. You need to make sure your beneficiaries stay up to date. So if you set up a trust or you have another child, you make sure you're updating that part of the account, the beneficiary, so that when you ultimately pass away, or if you pass away unexpectedly, what you want to happen with these accounts actually happens. And then you want to make sure you understand how these accounts fit into your overall tax situation, tax coordination. So it's not just a matter of you set up your IRA after you moved over an old 401k, or you open up an IRA or own and you choose some investments and boom, you're done. There's a lot of ongoing responsibility above and beyond just that responsibility choosing the right investments within that plan. The biggest misconception that I see when it comes to things like old 401ks is the thought that it's it's all or nothing. Either you have to roll the whole thing over into either a self-managed IRA or a managed IRA, or you have to leave the whole thing there. And which is good, which is bad, and all those things are really misconceptions that people go into, or have in their mind. The reality is leaving an old 401k, or leaving an old retirement plan, or moving it over, um, there's a lot of things that go into consideration when you choose which of those options you're going to do. It's not one is good all the time, one is bad all the time. And in addition to that, it's not always you have to move the whole thing over. That's the best thing to do. Sometimes you're going to want to leave some of the balance in the old 401k. Sometimes you're not. It just depends on your situation. But a lot of times clients come to me and they're like, I have to move this old 401k, or no, not necessarily. You may have other options, and you may not have to move the whole thing over. It just depends on that old company's plan, what options are available, and what's going to be most suitable for you. When we meet with clients, or prospects or potential clients that come to us, one of the things that we're going to do, and actually there's a multitude of things that we're going to do with them when it comes to these old 401ks and self-managed IRAs, is first, we're going to go through and help them identify what the account's really costing them. So we're going to look at not only the upfront fees, those administrative costs or account fees that are line items on their statement, but we're going to dig into some of those more buried fees within the investment choices, the expense ratios, and things like that. We're going to make sure they understand what all those fees are, what the administrative costs are, what the expense ratio fees are, so that the client has a better understanding of what they're really paying for in their retirement account. Because again, no retirement's free. Just because we analyze what those costs are doesn't mean we're going to make a judgment of this is unsuitable or suitable, but we want you to start from a place of understanding what you're paying, so you have a good expectation of what you should be getting for that fee and what it's costing you to have that retirement account. Second, We're going to talk about who's managing it. So, are you managing your self-managed IRA? Is someone else managing it for you? Are you managing your own 401k, or is someone managing it? Do you have any clue? Do you know if anyone's managing it? Do you know if anybody's reviewing the account? These are conversations we have all the time with potential clients when they bring us statements from old 401ks, old 403bs, IRAs that they have. Who's actually looking at this with you, or is that responsibility falling on you? Um, Part of that conversation is, who's looking at it, who's rebalancing this account for you. When's the last time you actually rebalanced your account to make sure that you're taking advantage of what the market's done for you and capturing some of your gains and maybe getting rid of some of your losses or whatever it may be. When it comes to rebalancing, that's part of the way that you grow your wealth is by proper rebalancing on a regular cadence. And so we'll ask you, when was the last time you rebalanced your account, or is somebody rebalancing this account for you? Next is, does this account still fit your life today? So, your old 401k from 10 years ago, that self managed IRA you set up when you left your old employer 15 years ago. When you set it up, you were in one stage of life, but now you're in a completely different stage of life. You're closer to retirement, you're closer to needing these assets. When was the last time you reevaluated that and do the investments, do the choices you made back then still meet the lifestyle that you have today? Um, how does it impact your taxes today? Is there other retirement accounts that these accounts should be coordinated with? Do you have brokerage accounts? What's your risk tolerance? Does this match your risk tolerance? Have you updated your beneficiaries? Let's look at who the beneficiaries are. And how does this fit into your overall estate planning? These are all things that when we meet with a potential client or we meet with a client and we're reviewing old 401ks and self-managed IRAs, they're all the questions that we're going to ask so that we have a really good understanding. And not just so we have a good understanding, so you as the potential client or as the client have a really good understanding of all these different aspects of the account and where it stands today. Fourth, we're going to talk about what options exist. Whether that be you can leave it where it's at, you can roll it over, you can leave part of it, roll part of it over, you can continue to manage the IRA yourself, you can have us manage it for you. We're going to look at all the options that are available to you, analyze them, educate you on all those different options, what the outcomes of those different choices might be should you make them. And the answer is not always, Brad manages this for us. I know that a lot of times when clients come to us, they understand we're asset managers, we're wealth managers. We help our clients manage assets. But that does not mean that's the default answer for potential clients or clients that have old 401ks or self managed IRAs. We're going to do a thorough analysis. We're going to discuss every single option that's available to you so that you're well educated and can make an informed decision. And sometimes our recommendation is going to be leave her where it's at. It's doing fine. There's no reason to do it. And maybe it's really cost effective, maybe it's very suitable, it's doing everything you need to do, or you're doing a great job managing it. Why would you make a change? Sometimes it's going to be, hey, here's a proposal that we give you. Here's something that we think we could do and improve your situation. But it's not a one size fits all. It really depends on the individual situation, the account, a lot of factors that go into it in how we're going to recommend moving forward. But again, we really want to talk about all the options, educate you on those options so you can make a decision on what's going to be best for you in your situation. I'll close with this. Um, when it comes to these old 401ks and these IRAs, a lot of them were set up with a default. So when you open up the IRA or you open up the 401k, excuse me, at your former employer 10, 15 years ago, you didn't want to go through and choose a bunch of mutual funds, so you chose the default investment choice. And there's nothing wrong with choosing the default, but that default may not match where you are today. It may not be serving you the way it was serving you back then. And so our goal in doing some of these reviews with clients and potential clients is to help them understand that the default may have been good then, it may not, or it may be good today, but let's make decisions on that rather than just stick to the default. And so we would love to meet with you. We would love to have the discussion with you. We do a complimentary consultation. We will do a complimentary review of your current retirement accounts, whether it be old 401ks, self-managed IRAs, or existing 401ks at your current company. We'll do that complimentary review. There's no obligation to work with us. We'll educate you on all the different things we've talked about today. We'll give you our recommendation on what to do, whether it's leave it, move it, manage it yourself, maybe have us manage it for you. We're going to give you an honest evaluation of that, and then you make the decision. But again, the big thing is you're going to be educated, you're going to be able to make a decision versus just stick to the default. I hope to hear from you. You can schedule a complimentary consultation below. There's also some more information below. We'd love to speak with you. Again, Brad Stevens with BAS Financial, and I hope this was educational and have a great day.